Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I guess the last point I want to make is, as the U.S. consumer, and believe it or not, if the pool of savings increases in the U.S. and we have a savings rate that goes to 10% of GDP, that number just about equalizes the amount of FX reserves held by Asia. And if you think of it this way, and we talked about global rebalancing, it means that no longer are we going to spend $1.2 trillion over that many years of the increase in pool of savings that's going to go over to Asia to buy goods. That's going to stay in the U.S. because we're not buying anymore. We're saving. That means that means they can take all of their $1.2 trillion or whatever it is away from the U.S. and it could potentially be a wash. So that's another point that we've kind of been keeping in mind. So we're not as concerned about that, and we see it really as a newsletter reason to buy gold.
And I think that's the last question. But I guess it's sort of the same answer I think that you just mentioned. What about? And there's a couple questions here about a lot of people that think the dollar is going to be moving much lower because of inflation, and people like the gold bugs that always believe that gold is going to 10 times the number that's trading at today. How do you square all that? It seems like every time that the dollar is a little weak, people you hear so much about gold and all those kind of folks that believe that the doom and gloom of and the ability to buy gold to sort of hedge yourself from that.
Yeah, we see this a lot, and when I speak, I see this a lot. This genuflecting the money supply, that because there's so much money being pumped into the system, it automatically equals inflation. Well, the reality is it doesn't. And for a current recent example of that, just look at the Japanese economy from 1989 when their stock market and their real estate market broke. The Bank of Japan pushed interest rates down from about 4.5–5% down to zero, absolute zero. And they stayed in the grips of deflation for about 14 years, and they're back in the grips of deflation. So it's not all about money supply. It's about consumers' ability to spend. You can lead a horse to water, but he may not drink, so to speak. All this money coming into the system, a lot of it's being soaked up by the major institutions to save themselves so they're not lending. Those people, as I said, that want loan, that can get loans that are solid, are rebuilding their balance sheets so they're not borrowing. And those that would borrow and spend have relatively poor credit in the as the standards are going up. So it's not all about money. So you have a falling. If this goes to what's called monetary velocity, as that falls off the table, and you see a decline in monetary velocity, which is the function of money supply relative to GDP. Mm-hmm. When you have major dislocations in the global economy, people get very scared. They don't spend. So the relative amount of money being pumped into the system does not have the same stimulative effect that it had before. So you don't have inflation, and people are very, they just think money equals inflation. Well, it's money and credit, and that's what the Austrian school of economists did, I think, differently than the monetary side or the classic banking side. They brought in this notion that credit is a huge driver of inflation in and out of the economy, because credit is basically a demand for cash. Credit is declining all around the globe. Even though the public sector is dumping massive amounts of credit into the system, there's $60–70 trillion of private credit out there that still probably has to be written off. The IMF just came out and said today, and I think doubled the amount of bad loans that are going to be written off. The amount of private credit still being deleveraged out of the system is still outweighing the credit that the governments are putting in the system, because the private sector is much larger than the government sector is putting in. So as that plays out, it's going to press down even further on the stimulative effect of money coming into the economy. Now, if we get to the end of the cycle and we do start to get a rebound and we cleanse this economy and all this money continues to be outstanding and isn't mopped up in some way, then there could be a major concern, and we're very open to the idea. But until we get through this period of real fear, we don't see inflation being a problem for a couple years, maybe, or more.
No, very good point. One other one from Dizal. how can the balance of payment, let's say to Canada, be used in making trading decisions when trading the U.S. dollar against the Canadian? Do you look at those balances? Is that just one part of the equation?
We look, we watch those, just, not to a degree, we don't scan line 3 of the balance of payments or anything, things like that. We do keep watch of them. In general, we think more of a global macro flow. What is the driver of Canadian growth? And it's been commodities have been a big driver. So this fall off in China, we see a correlation with Canada and oil prices and things like that. Obviously, the current account surplus going to the negative is just a sign of the major exports, which are commodities for Canada, kind of falling off the cliff, which is not good. So yeah, we watch it, but it's just part of the equation.
Well, Jack, I think you've taken so many questions, and you've spent a good portion of your afternoon, so I want to thank you on behalf of the IC. But before we do that, I want you to, if you have any closing comments or anything, please, feel free to just make those comments at this point, and then we'll wrap it up.
Well, I just think that, as I said, this is something that we've been working on for a while, and it's becoming more and more into focus into this in terms of this global macro view. And I think even if we are completely wrong, what it does for us, and I think what it can do for people, they try and think in these terms, is it just opens their eyes to other potentialities out there. And I think from a trading perspective, the more open you are to other information that's coming in to maybe invalidate your existing view, the better off you are. So we develop these long-term scenarios like this and try and have, real reasons why they can play out. And ultimately, if you get the long-term trend of the dollar right, and you just trade in that ballpark and generally take your trade setups that are in line with your long-term trend, you're going to tend to have a much better success rate in this market. And this is about making money over time. It's not about making money all the time or every time, but making money over time. And if you can trade in line with the long-term trend, you're going to tend to make money. And that's why we think this stuff is very important.
Well put, Jack. I mean, all my years of trading, I always felt that, and I see a lot of infomercials where people talk about being right 70, 80, 90% of the time, and it's not about that. Like you said, it's seeing the trend, capital preservation at the time. But on the other hand, that one example that you gave was great. The idea you can look out many, many months. You're risking $2 and whatever it was, 71 cents, with a chance to make a good deal of money, and that seems like it makes a lot of sense. Jack, I see you're coming back on May 14th, 21st, May 28th, and then I think you'll be back at June 16th. So I'm really looking forward to all those sessions. That's going to be great.
Well, thank you. It's really my pleasure, and thank you, everybody, for hanging on this long, this late in the afternoon. I really do appreciate it.
Well, thanks again, Jack. I want everyone to please check out blackswantrading.com. They have research. They have free trials. Obviously, Jack really understands the foreign currency market, so go and check out his site. He's got so much to offer. I just want to say thanks again, Jack. Really appreciate it.
Okay, Steve. You take care.
Take care. You too. And on the behalf of the International Securities Exchange, this is Steve Meisinger saying have a great trading day tomorrow. I want to thank all of you for being with us. And again, next week we'll have Tony Hansen. Following week, Dr. J, John Najarian, the market guys, and then Jack Crooks will be back. Please check out all those webinars. And again, if you're interested, come back to the archive. We have so much information on our website, www.isc.com/FX. Thanks again. On the behalf of the ISC, this is Steve Meisinger saying have a great day tomorrow. Bye now.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.